Leverage can build wealth or it can destroy it. Leverage is financial power, the use of borrowed resources to increase potential returns, but power without control is dangerous. Leverage does not create success on its own. It amplifies whatever structure already exists. When outcomes are positive, leverage accelerates growth. When outcomes are negative, it accelerates loss. This is why leverage feels attractive. It promises speed, scale, and faster results, but speed increases fragility, and fragility increases risk. Risk creates pressure, and pressure often leads to emotional decisions. Emotional decisions increase mistakes, and with leverage, mistakes become more expensive and harder to recover from. Leverage shortens the margin for error. Without leverage, financial missteps are often survivable. With leverage, volatility is magnified and recovery becomes more difficult. Many financial crises begin not because leverage is inherently bad, but because it was used without sufficient discipline, stability, or margin. Leverage removes margin in exchange for acceleration. That trade-off can be profitable, but only when controlled carefully. Wealth builders understand this. They focus on strengthening fundamentals first: stable income, controlled expenses, emergency reserves, and clear risk management. Only after structure is resilient does leverage become a strategic tool rather than a gamble. Also, a critical distinction between productive and consumptive leverage. Debt used to invest in income-generating assets can accelerate growth. Debt used to finance lifestyle consumption accelerates dependency and fragility. Productive leverage builds assets. Consumptive leverage builds obligations. Obligations increase dependency, and dependency reduces freedom. Since freedom defines wealth, leverage must be aligned with long-term independence rather than short-term appearance. Leverage also increases psychological pressure. Borrowed capital magnifies volatility emotionally, not just financially. Increased pressure can interrupt discipline, and without discipline, leverage multiplies errors rather than returns. Leverage itself is neutral. Its impact depends entirely on the strength of the foundation beneath it. If structure is strong, leverage can amplify growth. If structure is weak, leverage exposes that weakness quickly. This is why patience must come before leverage. Stability should be proven first. Control should be established first. Growth should be sustainable before it is accelerated. Strategic leverage creates scale. Impulsive leverage creates stress. True financial power comes from control, not acceleration alone. Leverage can build wealth when discipline leads, but it can destroy wealth when ego, urgency, or impatience take control.